Good day, good day. So this is a video that's been requested more than a few times. So thought I'd finally get around to getting this done. This is basically not only what things you need to do when you're creating a new business, but also things to look for when you want to invest in a business. And so I'm going to try to do both of those sort of at the same time in one video. Um, just some quick definitions to kind of get this stuff out of the way. LLCs. I've done a video before about LLCs, but they are created by states, not the IRS. Okay, and an LLC can be one of three things. An LLC can be a sole proprietorship, which files a Schedule C. It can be a partnership, which files a 1065, or it can be a corporation that files an 1120 or 1120S. All of that depends on how you register the LLC with the IRS. Okay. One of the benefits of having an LLC is that LLC members can be things like partnerships, whereas with an S corp, the members cannot be partnerships. And I'm going to put all the links for these things that we're looking at in the description of the video as well. Okay, and so here we see to qualify to be an S corp, you can only have individuals, trusts, and estates. You cannot have a partnership or a foreign corporation or a non-resident alien as a shareholder. And so the reason why that's really important is because as an S corporation, if I want to bring on an investor that, let's say, lives in the UK, right? That person that lives in the UK cannot be a shareholder of that S corporation. Can't do it. Okay. However, they can be an owner in an LLC. They can be an owner in a partnership, but not an S corporation. All right. And S corporation stands for small corporation. Okay. And the biggest thing there is that it can't have any more than 100 shareholders. And that's the reason why, if you're going after public money where you want to bring in as many investors as possible, then you have to be a C corporation because you're going to surpass that 100 shareholders pretty quick. All right. So now let's get to what things you need to do when starting a business. Okay, and this is IRS Publication 583, literally titled "Starting a Business and Keeping Records." And the reason for this is because starting a business is all about record keeping. Matter of fact, when I took my first semester of accounting, the one big distinction between those that got it and those that didn't was the ability to be able to separate personal from business. It's just, it has to be done. And everything about starting a business comes down to record keeping. And so that's what we're going to talk about here is the record keeping. All right. First things first, like I said, you must keep everything about the business separate. And this goes for, it doesn't matter if it's a sole proprietorship, it doesn't matter if it's an LLC, corporation, partnership, whatever, you must keep it separate. That means separate bank statements, okay, separate bank accounts. It does not matter if you have a business bank account or if it's a personal bank account, it needs to be completely separate, okay? So that means none of your personal expenses are coming out of the business account, none of your business expenses are coming out of your personal account. They are completely separate, okay? If you want to put money, if you want to put personal money into the business account, you must do it by transfer. Okay, you can transfer bank to bank. You can write a check, right? Um, but you cannot just like use your personal debit card for business expenses and think that that's transferring money. No, it doesn't work that way. You have to transfer. You have to deposit a check. Um, you can deposit cash, but we'll get into that here in a second. Depositing cash and using cash is very hard to keep track of. And remember, this is all about keeping records. All right, so we're gonna go through how to keep records and what that means. All right. Now, first things first, I want to say that you cannot manage money without record keeping. You cannot manage money without accounting. I will argue that you cannot have a successful business without managing money and without record keeping. It's just I've seen it done, so I know it can be done. Right? There's many entrepreneurs out there that are just not good at organization. They do not even think about managing money. They just do whatever they have to do, and that's fine. But for the most part, if you want to be successful in business, you must manage your money. You must keep track of what it is you're doing and how you're doing it. All right. So, first things first, financial statements. This is something that comes up all the time. I have people that call me that say, I need financial statements. And my question is always, well, why aren't those readily available to you? Right? What have you been doing for the past, year or 2 years or 3 years that you've been in business that you don't have financial statements already ready to go? Right? Having to do that stuff at the last minute means that you're gonna have to spend extra time and usually extra money in getting those financial statements created. So start from the beginning. Okay. Financial statements is simple as income minus expenses equals profit. That's simple. Income minus expenses equals profit. We'll talk about the balance sheet here at the end, but that is also very important. All right, kinds of records to keep, and we'll also talk about supporting documents. But the kinds of records. Let's see here. Okay, I'm looking for a specific. Here we go. Except in few cases, the law does not require any specific kinds of records. You can choose any record keeping system suited to your business that clearly shows your income and expense. Okay. And the reason why I wanted to bring this up is because this comes directly from the IRS. Except in a few cases, the law does not require any specific kind of records. Okay. And so what this generally means is that however you do your record keeping is completely up to you. But I will say that in practice, that is not the case. The reason being is because there is a very simple accounting principle that says that your accounting record, and this is not IRS, this is accounting principles. Okay. Something to keep in mind, accounting is the one thing, and there's more than one, but it is one of the few things that is global, right? There, accounting principles, accounting methods, and accounting practices are the same everywhere you go on the globe. At the end of the day, counting is counting, and accounting and all those accounting principles are the same no matter where you go. And one of the most important accounting principles is that any person from anywhere ought to be able to pick up your accounting records and easily and clearly understand it. And so that's the reason why, like I said, the law does not require any specific kinds of records. However, accounting principle states that your books, your records, right, the way that you keep your records must be clearly and easily understandable by any random person that just walks by and picks them up. And then what that means is they don't have to ask you questions. They don't have to wonder what things are. They ought to be able to just pick up those records and know exactly what's happening. And you have to think about that when you are keeping your records and you're keeping your books. Can any random person understand this stuff without me talking to them? I have clients all the time that'll tell me something like, well, I can send you my accounting records, but I'll need to explain them to you. Well, that's a problem. If you need to explain it to me, something is wrong with your accounting, period. There is no reason for you to ever have to explain anything to anyone if you're keeping good records. So keep that in mind. That's the most important thing outside of making money, right? Is keeping those records. All right. Um, Now let's talk about the supporting document, okay, and what these records actually are. All right. So it says very clearly here, supporting documents, which is the records that you're going to keep, are any purchases, sales, payroll, and other transactions you have in your business. Generate supporting documents. Okay. This is going to be sales slips, paid bills, invoices, receipts, deposit slips, canceled checks. All right. And I want to quickly say here too is that um, generally speaking, all right, government is way behind on what the private business um, sector is doing. And I can say that's probably the case in most countries, if not all, right? The government is always behind what the private business sector is doing. When you see words like canceled checks, now keep in mind, of course, there are businesses that still use checks. There are people that still use checks. However, um, I don't. It's not as common as it once was. Okay, and so the number of people that are keeping canceled checks, I can't imagine it being the majority. So keep that in mind too when you're dealing with the IRS, is that they are way behind times when it comes to what private business is doing. And so it is your job, if you're dealing with the IRS, something like an audit or anything like that, to explain, like, hey, listen, I know you guys are asking for this thing, but no one does it that way, right? Here's how we're actually doing it. And sometimes you have to really explain to them, especially if you're talking to someone that works for the IRS as an employee for a living. They've never been an entrepreneur. They've never owned a business. They just don't know, right? So anyway, these are the again the supporting documents. It's any sort of purchase, any sort of purchase, any sort of sale, any sort of payroll. Those things you have to have records and supporting documents for. Okay. All right. And it says it is important to keep these documents because they support the entries in your books and on your tax return. Keep them in orderly fashion in a safe place um, and organized, right? They must be organized by year, type of income, or expense. I'm going to say here that the most important thing is organization by year. Um, you'd be surprised how many people don't have their books organized by year. It's crazy. Um, but that should go without saying. All right, gross receipts. Again, we're going to see where the IRS and government is just kind of behind on times here. What are gross receipts? Whenever someone pays you for anything, what records do you have to prove that someone paid you? And this is very, very, very important. I have seen many, many times, specifically with single mothers, okay, single mothers who are filing a tax return with children. They are due a tax refund, okay, and they have a small business and they are sole proprietor and they have income on that tax return. And IRS says, hey, before we send you this refund, you have to prove this income, right? Well, how do you prove that income? You have to have some sort of record, some sort of receipt that shows that you received that income. Cash register tapes. Who has a cash register these days? But it is on the list. Okay. Bank deposit slips. All right. This is if you are receiving cash and you deposit that cash into the bank is going to then give you a bank deposit slip. Okay. This is a very serious thing. I have met many people who get paid cash and spend cash and then put those cash payments on their tax return. Doesn't work that way. Not a good idea. Put that money into the bank and then either transfer it to your personal account or use a business debit card to purchase business expenses. If you want to pay yourself, like I say, transfer it to your personal account. But if you receive cash and you spend cash, do not plan on putting those cash payments on your tax return. Receipt books. If someone pays you money, you send them a receipt. Okay. And that can be done many ways. Personally, I use email to send persons receipts, and those receipts are literally my record of showing that, hey, someone paid. Invoices, same thing. I like to send invoices. Every so often, I have someone that I'm very familiar with that will just text me or call me, and I'll say, hey, I'm going to charge you this money. And they say, okay. And a lot of times they'll send it to me right away, and I don't even send an invoice. But that can be a problem, specifically when you're talking about building a business, because later on, a year later, 6 months later, the same person calls and says, "Hey, can you do that thing for me?" And you say, "Well, how much are you charging me?" And personally, I like to charge people the same price that I charged them last time. Well, if I don't have an invoice, I have no proof. I have no way of going back to say, "Oh yeah, you definitely paid me this much for this service," before, right? And so I can charge you the same thing. So invoices are important. Credit card charge slips. Now, we're talking about um, gross receipts here. And so credit card charge slips, I imagine, are going to be, again, we're talking about behind on times, right? But I imagine they're going to be when you charge a card, the card machine prints out a receipt, one for you and one for the customer. And so these credit card charge slips, I'm assuming, are the receipts that the machine prints out for you. Okay. I know that a long, long time ago, credit cards first came out, they were doing carbon copies of the physical card. And those carbon copies, I believe, were called credit card charge slips. So again, talking about way behind on times. And then the easiest forms of record keeping for these funds are going to be 1099, right? So if you are working for some company or whatever, that company can send you a 1099, and that 1099 is usually proof enough of your income. Now, this can be done on a small individual basis, fairly simply, right? But it does require your customers' um, um, approval, basically. Like, they have to be okay with with filing a 1099 for you. But it can be done, and it's not expensive at all. It costs maybe $2 uh, per 1099. But again, that 1099 is proof positive of your proof of income. The other thing I want to mention here is that if you are in a situation where you're being audited, or sometimes if you're dealing with a bank and you're trying to get a loan or something like that, and they're asking you for this type of proof, this stuff can be prepared after the fact, right? So, meaning if someone pays you in January, trying to prove this stuff, uh, you know, January next year, you can definitely prepare these items January next year to prove a receipt from January last year. All right. But again, when you're doing this stuff last minute and you're doing it, way after the fact, usually it's going to require more time, usually more money. So it's best to just do it from the beginning. All right, inventory we're not going to go into, but again, it's pretty much the same thing. You have to keep up with what you are purchasing. Same thing with expenses. Again, you have to keep up with what you are purchasing. Now, what I wanted to get to, which is really important, is if you are making payments by check, the IRS specifically states what the record needs to look like. Okay, so if you are paying something by check, then you have to have a check number, you have to have an amount, you have to have the payee's name, you have to have the date the check amount was posted to the account. Okay, if you're doing electronic funds transfer, and this is again is transfer from bank to bank. You have to have the amount transferred, the person's name, and the date the transfer was posted to the account. All right. Now, this is really important. And if you notice here, what you don't see is I don't even know the technical term for it, but when you talk about Cash App, when you talk about Zelle, when you talk about um, uh, Venmo and these sorts of things, these are electronic funds transfers, right? The problem becomes Venmo, Cash App, and those persons um, do not do not list a pay's name. Usually, it's going to be a user, right? And that can become an issue with the IRS when trying to prove money sent or money received because it's not actually coming from a name, but it's coming from a user. But according to the IRS, this has to be okay. And this is something that has not been decided yet, but it will be sooner or later, right? Where they're going to have to accept those types of electronic funds transfers going to, 555 okie dokie, right? And versus like an actual company name or something like that. All right, credit cards. Again, this is something that took a long time to come about because for a long time the IRS did not accept just simple credit card statements and bank card statements. And so it's very simple. It's amount charged, the pay's name, and the transaction date, right? They do put a caution here though. It says proof of payment of an amount by itself does not establish you are entitled to a tax deduction. Proof of payment of an amount by itself does not establish you are entitled to a tax deduction. And that is the IRS's way of saying, hey, if you come in here with a credit card statement that shows an amount, that shows a pay's name, and it shows the date, you may not be entitled to that tax deduction. Same thing with the electronic funds transfer. Just because you sent $5,000 to 555 okie dokie, you know, doesn't mean that we're going to allow that as a tax deduction. It's really important that you have those detailed receipts, invoices, and so forth. Talking about journals and ledger books. Um, we can talk a little bit the about payroll because that same thing I come across it so many times. You're paying someone to do a job, and man, just recently, so this this customer, this client of mine, was paying uh, a contractor through Cash App, but the money was going to what was obviously a woman's account, right? Really, really, really hard to prove. Really hard to prove, as you can imagine. Again, we're talking about accounting principles, someone picking up your accounting records and easily and clearly being able to understand what is happening, right? And so for you to say that you paid, you know, Jason Voorhees $1,000 to do a job, but your accounting documents, supporting documents, show that you paid Nina 246. I mean, what am I supposed to do with that, right? You said you paid Jason Voorhees. Who is this Nina 246, right? So anyway, that can be an issue, and that's the reason why it's so important that you try your very best to make sure that you get good records, right? You want to pay someone via check, bank transfer if you can. Definitely get that W-9 signed, right? And make sure you're issuing the 1099 at the end of the year because issuing the 1099 to that contractor is proof positive that you actually did pay them this money, right? All right. Now, this is how long you ought to keep your record, okay? Now, the IRS has some fairly liberal timelines, as you can see here. Um, if you file a fraudulent return, there is no limit, meaning that the IRS usually has about 7 years to come back and say that, hey, this return that you filed is completely fraudulent. Doesn't happen often, but if it does, then there is absolutely no limit to how long you're required to keep those records. What I tell people is typically 3 years, and I'll say for payroll, 7 years, just to be safe, just to be safe. But these are the actual numbers. Okay, so uh, any additional tax. So if the IRS wants to come back and say that you owe some additional taxes because of maybe an audit or something like that, 3 years is how long they expect you to have those records, and that's why, typically speaking, they'll audit you within that 3 year window. Okay. Um, do not report income that you should report and is more than 25% of gross income shown on the return. Okay, so again, this comes down to, again, single parent filing a tax return with business income for a refund. If the IRS determines that that income was not valid, 6 years. And what that typically means is that they can actually go back 6 years to recoup any of those monies that was sent to you, and they expect you to be able to prove those transactions 6 years ago. Okay, and as far as how to keep records, I'm going to always suggest a computer, email it to yourself, and keep up with your email login. You can keep the file saved in your email. You can always go into your email and pull it up. If not, like a thumb drive, cloud storage, or something like that. And then, yeah, credit for a refund, same thing, 3 years. And then this one is a bad debt deduction, 7 years. I don't know why this one is so long, to be honest with you. I've talked about this in the previous video, but it's a very simple thing. If you make a loan to someone and they don't pay it back, you can write that off as a deduction. But the IRS can go back 7 years and they expect you to have those documents from 7 years ago, which is usually just going to be a name, some kind of contact information, the amount of the loan, and maybe a signature. All right, so that's record keeping. The other thing that I want to go through is this is IRS Publication 542. It is literally just titled Corporation. All right, and this is everything that you can think of concerning corporations and the IRS. Okay, and there's one in particular thing that I wanted to talk about today. Number one, the different kinds of corporations. We kind of already talked about LLC, S corporations, personal service corporations, which I won't go into. Maybe I'll do another video about that later. And then, of course, the C corporation, which has more than 100 shareholders. All right, this is what was important here. Property exchange for stock. Okay, when you are starting a business, when you're creating a business, the business starts with $0. It has absolutely nothing. It owns nothing. It has nothing, right? And the only way for this company to have anything is that an owner has to transfer that property to the company, whether it be cash, whether it be an asset, whatever it is. Some person, some entity has to transfer the asset to the new company. And when that is done, the company is going to issue stock to that person, to that entity in exchange for the asset. Okay. So let's say you have a new company and you put in $100. You have to transfer. And this is why I say when you're dealing with business, okay, you get a separate bank account. And if you want to move money from personal to the business, you transfer. You either transfer it bank to bank, you deposit a check, or you do something that's going to give you a paper record that you can easily pull up and easily keep. Okay. And that can clearly show you where the money came from. That's the other thing, right? It needs to show that this money for sure came from you and went into the business. Okay. Now, and of course, that's going to be non-taxable. Okay? It's not going to be taxable at all when you do that. All right. So the one thing that I come across all the time that people don't think about is what's called soft asset, right? Or intangible asset. There are things that you are giving to the company that that isn't something you can hold, right? It isn't money. It isn't something that you can physically pick up and put down, right? And those soft assets are things like, for instance, an employee contract, right? So when I started my business, I made a contract with the business that said that I'm going to work for that business for a certain amount of time. That is a valuable thing because that contract states that I cannot go work for any other competing corporation if it means that I will, not be able to fulfill my duties for this particular corporation and business, right? So there's an employee contract, and that has value. And how you value that contract is you can value it a couple different ways. We won't go into it, but the point is it has an actual dollar value. That contract may be worth, I don't know, 10,000, 20,000, $100,000. The reason why is because if you sign that contract and then you sell the company or the person that you sell it to now owns that contract and you now have to work for them. Okay. And so that is valuable. If you wanted to sell that company, they will, like I say, get that contract. So anyway, the point is it has value. And because it has value, it is amortizable. Okay, it's amortizable, meaning that it is a tax deduction. And it's as simply as taking the total value of that asset, dividing it by 15, and that is your tax deduction every year. So if you're talking about a $15,000 value, it means $1,000 tax deduction every single year for 15 years. Okay. The other type of soft asset that I see a lot is a client list, right? This particularly comes into play if you are someone that was maybe working for a company and now you're starting your own company and you're bringing some clients with you, right? The value of that client list is valuable. It's probably the most valuable thing that the company owns outside of your knowledge and expertise, right? And so you have to be able to evaluate and put a dollar amount on what that client list is. And again, there's multiple ways of going about doing that. I also mentioned knowledge and expertise. The knowledge and expertise that you bring into that business is also going to be a soft asset that has value. It's a lot of times going to be the most valuable thing that the company has starting out because remember, it doesn't have any income, right? So how do you come to own the shares, right? How did you own the shares? They can't just magically be given to you. You have to exchange something for the shares. You have to, right? And so again, those are the things that you have to think about when you are starting a business is what are you giving to the business? And then once you have that information, now, like I said, we have amortized property, which can be a tax deduction for you. All right. So I want to talk just real quick about kind of how that works as far as exchanging shares and what that looks like. Okay. So this is a K1 from an S corporation. Okay. So if you own an S corporation, if you are an investor in an S corporation, you will receive a K1. Okay. And on that K1, it is going to list the number of shares that the corporation had. And that is something that is going to be dictated by the organizing document of the company when they first started. Many times you start with just 100 shares, but it can be 1,000, it can be 10,000, it can be 1,000,000, right? What matters is how those shares are divided. Okay. And so this is what it looks like. Each owner of the S corporation is going to own a percentage of the shares. So whether it be 5%, 10%, 20%, right? So for instance, let's just put some numbers to this. If the corporation has, let's just say, 10,000 shares to begin the year, and let's just say they didn't issue any new shares. We'll talk about issuing new shares, but it's 10,000 at the end of the year too, right? And this particular owner owns, let's just say, um, you know, 10% of those shares, right? You still have to come here and say how many shares that is. Okay. And again, when you are issuing new shares, the question becomes, does the owner get those new shares? And that is something that, again, is going to be dictated by the organizing document and bylaws. We'll get to that here. If there's any loans from the shareholder, that's going to be here as well. Okay. And so these are the things that must be understood when you are deciding to invest into an S corporation, right? You have to understand, number one, how many shares overall does the S corporation have? You want to know what your percentage will be, okay? And that's going to be based on what you have contributed to the S corporation, okay? And then whether or not there's going to be any loans, because you can either loan S corporation money or you can contribute. So, again, that's completely up to how you want to structure your business dealings, but you have that option. All right, for partnerships, and remember, an LLC can be a corporation or a partnership. So um, any one of these situations can go for an LLC. All right. So for an LLC, I'm sorry, for a partnership, there's going to be different kinds of partners. Remember, for an S corporation, you're limited to what kind of owners the S corporation can have. That's not the case for a partnership. For a partnership, you can be the domestic, means American resident. You can also be someone that is not an American resident or citizen that maybe lives in Australia or something like that, right? You can be an owner or a partner rather in a partnership. You could the a partner can also be another entity. For instance, it can be another LLC. It can be another nonprofit. It can be all these different things. Partnership can also be a retirement plan, 401k, an IRA. All these different things can be inside of a partnership. All right. Now, here's the big difference between partnerships and corporations. For partnerships, you can choose, and again, this is depending on the bylaws as well as the organizing document and also the partnership agreement that you have with the partnership, what your percentage of the profits and losses will be. For instance, you can have 10% of the profits, but 20% of the losses. Meaning that if the profit is $100, your profit will be $10. But if the partnership has a loss of $100, then your loss will be $20. Okay. And so it's really important to have that understood in the partnership agreement. Right. And so again, if you're starting a business, if you're starting a partnership, these are the things that you must have in your document to make sure that everyone understands how this partnership is going to be run. If you are investing in a partnership, it's very important that you understand in your partnership agreement how the profit and loss is going to be dictated. Okay. Now, the capital percentage is also something that can be dictated by a partnership agreement, but usually not. Usually, the capital percentage is dictated directly by what capital you put into the partnership to begin with. All right. Also important to understand is that with partnership, you can sell and exchange your interest in the partnership, which also changes what it may have been at the beginning versus at the end, right? Because remember, anyone and anything can be part of a partnership. So if, and again, this is something that needs to be understood in the partnership agreement, in the operating documents, and the bylaws, which is if I own, let's just say, 10% of the profit of this partnership, can I then sell 5% of my profit to someone else? Right? Can I do that? The partnership agreement is going to dictate that. The bylaws are going to dictate whether or not the other partners have to agree on whether or not you can do that, or whether or not they have to agree or vote on who it is that you're selling to. Because maybe we don't want this other person or other entity to be a part of this partnership, right? That sort of thing has to be discussed in those documents. All right. Next thing, you'll notice here that with the S corp, the loans from the shareholder is very straightforward, very simple. It's just a loan, right? With a partnership, however, you have this recourse and non-recourse. I'm not even going to go into qualified non-recourse financing, but what this means is that if you make a loan to the partnership, if it's non-recourse, it means that you cannot, if the partnership cannot pay you, then you cannot take anything from the partnership, meaning that the loan is not based on any asset, right? Like you're making this loan, if you get paid back, you get paid back. If you don't, you don't, right? If you make a loan under recourse, however, then that means that the loan is tied to some sort of asset. Now, that asset can actually be income. That asset can be something in the partnership. But if you don't get paid back, then you as a partner can take control of that particular asset, whether it be cash, whether it be a truck, car, house, whatever it is, you have that option. And again, this is something that you must spell out in your bylaws and your operating agreement and your partnership agreement. Because if not, you can run into some real issues if you are receiving loans and stuff like that from partners. I spoke with the gentleman this past year that has a partnership. He brought in investors, and this is the issue. He brought in quote unquote investors, right? But it's a partnership. And so I explained to him, I'm like, well, they're not investors if it's a partnership. They're partners, and as partners, you have to decide whether or not they're contributing a loan to the partnership or they're contributing capital to the partnership. And depending on what they're contributing depends on how you treat it. If they're contributing a loan, okay, well, it's going to be recourse or non-recourse, right? And if it's a loan, that means that they get paid back no matter what profit the partnership makes. So if the partnership has a loss, that partner is still due that loan plus interest, right? And that interest has to be stated, right? You have to think about it. As an investor, if you're going into a partnership and you're saying, hey, I'm going to give the partnership $10,000. And for this $10,000, the partnership is going to pay me $1,000 every year, right? It doesn't matter if the partnership makes $1 million or if the partnership loses $1 million. That partner is going to receive $1,000 every year for their $10,000 investment. Okay? As an investor, you have to understand that going in. As someone that's creating a partnership, you have to understand that going in. Or is it going to be that the partner is going to contribute $10,000 as a partnership contribution, in which case they will then own a percentage of the capital, right? So let's say the total capital, assets, cash, all that stuff for the partnership is $100,000. Or I'm sorry, let's say $90,000. Make this easy math, right? It's $90,000, and then you come in and you put in $10,000. So now the total is $100,000, and now you own 10% of the capital. Okay, that is capital contribution. You now own 10% of the capital, but that does not mean that you automatically own 10% of the profit or 10% of the loss. That has to be again dictated and put in writing by the bylaws, the operating agreement, the partnership agreement. Okay, and I keep saying those three terms together because they are interchangeable. Also, keep in mind that each state is going to govern the way that partnerships and corporations operate. Okay. Just recently, Florida does not require the bylaws to be registered with the state. So what that means is if you are in Florida and you want to invest in a company in Florida, there is no state requirement that those bylaws be registered with the state. So if you run into an issue where the person that you're investing with is, stealing your money or something like that, there's nothing on the state record that says that the company can't do that. Okay. You have to have something in writing, notarized and signed by that general partner that states what they can and what they cannot do. That is your only proof that you have to then go to court and say, hey, this is proof that this person is robbing, right? If you don't have that, you have nothing because the state of Florida does not require that the operating agreement or bylaws be registered with the state. In a state like Texas, you do have to register those bylaws, not that operating agreement, and it makes it a lot easier for everyone involved because as an investor, as a partner, I can then go to the state district attorney's office and say, "Hey, this person is stealing from me. The operating agreement on file says that they can't do that, right? And so I need you guys to go in and make this person do what's right." And it's very simple. It's public record. Everyone can see what that operating agreement is. Now, there are some benefits in not having to file that operating agreement, right? Because maybe you don't want people to know what kind of deals you're doing with your investors and your partners, right? Maybe you don't want people to know that you are giving your partners a guaranteed stated interest plus a percentage of the profit. Maybe you don't want people to know that, right? Because maybe with another partner, you don't want to give them a guaranteed stated interest plus profit. Maybe you just want to give them profit and no guarantee, right? But if it's public record, then I, as an investor, can go and look and see, oh, well, you've been giving everyone else stated interest plus profit. I want the same thing, right? So that's one of the benefits of not having to register that stuff with the state. But again, when it is registered with the state, personally speaking, I think it's much more easier and better for everyone involved because there are no misunderstandings. Everybody knows what's going on. All right. And that brings us to the capital account analysis. And again, this is going to be on every K1 every year for a partner involved in a partnership. Okay. It's going to show the beginning capital account. So let's just say you're a brand new partner and you just started with these people, right? So your beginning capital account is going to be zero. You contributed $10,000 for the year. And let's say that the partnership profited $1,000. Okay. Or I'm sorry, the partnership profited $10,000 and 10% of that profit is yours. So $1,000, right? Did you have any other increases or decreases? Well, maybe throughout the year you decided to, bring in a client list. Let's say we value that client list at $100, just to make things easy. Okay. Now the question is, and again, this is something that must be dictated by the operating agreement, the bylaws, and the partnership agreement, is when are you allowed to withdraw your capital? Okay. Here's why this is important. Remember, as a partner, I put in $10,000. Okay. Legally speaking, I can withdraw that $10,000 anytime I want to. So I can put in $10,000 today and I can call you tomorrow and say, hey, I want my $10,000 back. There's nothing that stops me from doing that, right? Now that does mean that once I withdraw that 10,000, I no longer have an interest in the partnership unless I've put in some sort of capital, right? But if I just put in 10,000 and then tomorrow I say I want 10,000 back, you have to send it to me. Otherwise, you have a lawsuit, right? And that's why, again, operating agreement, bylaws, partnership agreement must state when withdrawals can happen, how they happen, right? Um, for instance, if I have partners, right, and I have in my operating agreement that they can withdraw capital after 1 year, right, and that once they request a withdrawal, they must be given the withdrawal within 48 hours. Let's just say 2 business days. Okay. Now let's say I'm on vacation. I'm out somewhere doing something, right? And a partner says, "Hey, I want my money." Legally, I have 48 hours to get them their money, right? But if I'm out of town, if I'm doing something else, if I can't get to it, guess what? That's why it is so important that you have backup, that you have someone somewhere else, right, that can do these sorts of things when you can't do them. And again, this stuff must be dictated in the operating agreement, the bylaws, in the partnership agreement. Now, I've said all this stuff, but if you have a corporation that's only going to involve you and maybe your wife or something like that, you're only going to have a partnership that involves you, maybe your children or something like that. None of this stuff may be an issue, right? You won't have to worry about it. But if you are dealing with investors, you're dealing with other people's money, you're dealing with people that you are not necessarily super close to or really familiar with, you want to make sure that all this stuff is dictated. If you are an investor that is investing in these businesses, and to be honest with you, I don't even care if it's family members or a friend. You want to have all this stuff um, put on paper. Yeah, let me back that up. Even if it is your husband, even if it is a wife, this stuff needs to be dictated and put it on paper so that there are no misunderstandings, there are no issues, especially in divorce proceedings, right? If this stuff is not written, then there's going to be a real issue when it comes to dividing up this capital, when it comes to dividing up these profits, because you never put into to words how that's going to happen, right? Um, so again, the way this works is, let's just say we didn't have any withdrawals. Okay, so we didn't take any money out. Okay, and then we're going to have an ending capital account. All right, so the ending capital account is going to be 10,000, 11,000, 11,100. Okay, and then the way that works is next year you're going to add up this number plus the other ending capital accounts for all the other partners. Okay, divide by the number of partners, and that's how you're going to come up with the new capital beginning, because now maybe it's 11% because maybe another partner took some money out or something, um, and so their capital changed, or maybe you have a partner that didn't put in this soft asset, right? So there's a lot of things that can change year to year, and for most partnerships, in my experience, this capital number changes year to year, and it's really important that you keep up with the change from beginning to end, because guess what? Every year that you file this partnership return, these numbers are going to follow you, and the ending number must be the beginning number of next year, right? And depending on what happens here, is going to tell you what the ending number is going to be for this year, right? So again, record keeping, really important. I wanted to show just real quick kind of how this works, because I got this question a couple weeks ago, and the question was, what do you think is a fair percentage to give someone that contributes a truck to a trucking company, right? And anytime I get questions like this, I want to give just like easy, straightforward answers. But in so many cases, it's like, well, you have to understand the accounting to understand how to answer that, right? And my answer was simple. It's like, well, whatever percentage of the total assets this person has contributed, that is a fair number for the contribution for the partnership. So I'm going to show what that looks like just real quick. So in this case, we're just going to have two partners. Okay, just keep things simple. But as you can imagine, there could be 6, 7, 8, 9, 10 partners. But just two partners, just keep things simple. Okay, so let's say partner one puts in $1,000 cash. Okay, all right. So what that means is that this partner now has equity of $1,000, right? Okay. And as you can see, they own 100% of the partnership. Okay. Now, let's say we're just going to put truck in here. And let's say we have another partner too that now wants to contribute a truck. Okay. And let's say that truck is $20,000, right? So now this partner has $20,000 of equity. Okay. Now, here's why this is important. This partner legally, fairly, you want to be fair and just about this, right? Owns 95% of the partnership, of the capital, right? Now, does that necessarily mean that they are now going to be given 95% of the profit and 95% of the losses? Well, here's the thing. If I'm this partner, right? If this partner calls me and says, hey, do I get 95% of the profit from this partnership? I'm going to say yes, of course. No question, right? Because you own literally 95% of the partnership. All right. Now, what if partner number one has this soft asset, right? Maybe they have the know how, maybe they have the information and the knowledge to create this thing, right? Again, you have to be able to put a value on it. You have to be able to put a value on it, all right? Let's say that value is, let's just say 100,000, okay? That's going to increase their ownership equity to $101,000. And so now they own 83% of the partnership, they own 17, right? And this will be a fair and just number, right? So this partner getting 83% of the profit, this partner getting 17% of the profit makes all the sense in the world. Makes all the sense in the world, right? Okay. What if now, so this partner, $20,000 truck, right? But let's say we, instead of set it up as a truck, let's say it's a loan, right? So he's loaning $20,000 to the partnership, and now the partnership has to pay him the $20,000 back plus interest instead of it being equity. All right. Well, now what that means is that he does have the equity of $20,000, but it's also going to be stated interest on top of that, right? Now, does that mean that he's going to get 17% of the profit if he's getting stated interest as well? Maybe not, right? And that's why this stuff matters, okay? And that's why you can have 17% of the capital, but a less percentage of the profit, right? Because part of his profit, and I'm using air quotes when I'm saying part of his profit, is going to be the interest that he's receiving on this $20,000 loan. So it's not really fair that he's getting 17% of the profits plus extra interest on a loan, right? And so it makes sense that he would get less profit even though he still owns 17% of the capital. Okay. I think that's straightforward enough. Again, you know, understanding this stuff is what will help you be able to go into these business deals and basically not get screwed over. I see it so many times, right? So if you're going into a business, you want to make sure that you have the operating agreement, those bylaws, that partnership agreement, if it's a partnership. If you are an investor, same thing. You want to make sure that you are getting those documents. You want to make sure they are signed, that they are notarized. Okay. And I'll even go so far as to say you need to have wet ink signatures, meaning that it's not a photocopy, right? Meaning that it's an original document with an original signature with the original notary stamp. That way, when you do go to court, if you go to court, no one can say, "Oh, he he forged those documents. Those are just copies." Like, no, 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 no. I can smudge the ink on this thing, right? This is original. You want to have that, and you also want to have a copy of that person's identification as well, just to prove that, hey, this is a picture with a name, with a signature, notarized by someone who also saw the same ID, the same person, in the same signature. Okay. I think that was it. This is just something about bylaws. It does state that most state laws require the corporation to establish company bylaws. Bylaws ensure consistent, agreed upon voting and decision-making procedures, not particularly important should an officer or director leave the company. Sometimes, depending on the state, those bylaws are public and can be seen by everyone. And it says, even when not required by state, it's important that your company establish internal operating rules, right? Articles of incorporation is part of that. Most states do require that and do make those publicly available. But like I say, in the cases of like Florida, the articles of incorporation just state basically who owns the company. And that's another thing too, right? If you are a partner, if you are an investor in an S Corp, you want to be sure that your name is registered with the state. Reason being is because you're going to look really silly showing up to a courthouse and saying that you want to sue a company for taking your money and you aren't even an owner of that company. Think about that for a second. You gave somebody, $10,000, $100,000 to be an investor, to be a partner, and then you show up at the courthouse and they say, we have no record of you owning this company at all. Like, there's just like, we don't know who you are. We don't know what you're talking about. Unless you have some like hard evidence, right? Which is usually written documents with signatures and stuff like that, showing that you actually own this company, then you have no case at all. So the articles of incorporation, most states will require those. I think Nevada is one of the few that do not require that does not require public articles of incorporation to show who owns what. But again, even if it's not required by the state, even if it's not publicly available by the state, you want to make sure that you have original wet ink signature notarized documents stating everything: who owns what, how they own it, why they own it, right? You want to know when you are able to receive financial documents, whether it's every quarter, whether it's every year, whether it's upon request, right? And if you request it, how long do they have before they have to give it to you? Is it 1 business day, 2 business days, 5 business days, right? If I ask you, hey, send me bank statements, do they have to send you bank statements, or can they just provide you with a profit loss statement, right? All these things are important when you're investing in a company. Specifically dealing with the stock market, right? Publicly traded companies that are regulated by the U.S. government, right? They are required by law to provide quarterly financial statements every quarter. They do not have to provide bank statements, period. They are required to have an audit done every quarter, okay? And that audit team does have access to the bank statement, but you as an owner of that corporation, as a shareholder, do not have access to those bank statements. You do have access to the auditor's report, and you have access to the financial statement, the profit loss and balance sheet. That is it. There is voting that takes place with publicly registered companies, right? So you can vote on certain things. And the same goes for any sort of corporation, partnership, or LLC. There is usually a vote that can happen. And again, the organizing documents and the bylaws dictate exactly what you vote on, how you vote, when you vote, um, and again, what can be voted on, right? In some cases, the vote is majority, meaning that if I own 85% of the company, I get 85% of the vote, meaning that if you are an investor, if you are a partner, and you own 15%, your vote doesn't matter, right? Um, but that doesn't need to be the case, right? You can have bylaws and operating agreements that dictate that even if I own 85%, I still only receive one vote, right? And in that case, you have to have an odd number of partners or owners to always have a winning vote, right? And then you have to dictate in the operating agreement what happens if you have an even number of, right? All this stuff needs to be in writing to make sure that there are no issues, no arguments later down the road. Because the last thing you want to do is to go into business, and especially if you are sincere about bringing in investors and doing good business, you want to make sure that they are always aware of what is happening, why it's happening. And if they do have any questions, you want to be able to address those questions, answer them quickly and clearly, right? All right, that's it from me to you.